Welcome to tonight's Master the Trade webinar. Please feel free to put your questions on the chat the moment you have them, and we will answer as many as we can at the end of the presentation. So it's been a negative and nervy week, with start to the week, as the rapidly increasing virus cases across major parts of the US and potential major lockdowns in Europe and the UK have added to the uncertainty facing markets due to the upcoming US election. With that in mind, the structure for this evening has a US focus. Nick Geach, one of our US trading mentors, is going to start with everything you need to know about the US election with 6 days left to go. Nick is a 35-year veteran of financial markets, having worked on the trading desk at Citibank, Chemical and B of A before moving across as a portfolio manager on the hedge fund side. He will hand over to Maurice Pomeroy, who will lay out why gold is an alternative investment in financial markets, after which he will give his real-time thoughts on the market right now. Richard Adcock is going to discuss a new topic of understanding momentum and using the slow stochastic as an analysis tool before going to the live Pepperstone charts. Nick, over to you.
Awesome. Thanks very much, Chris. Appreciate it. Welcome, everyone. Thanks for joining in. So quite clearly, the upcoming election here in the US is the major event on the calendar horizon. And for those of you that are unfamiliar with the US election process, I'm just going to give a very brief overview. So the winning candidate is determined on a first past the post basis, which is similar to the UK. And this simply means that the candidate first achieving a simple majority of congressional districts or constituencies is declared the winner. And generally, this means that the winner of the national vote is also the winner of the election. And with the polls where they are right now, this would suggest a Joe Biden win. However, in the US, there is an additional level of complexity in that the winner is determined by a process of the Electoral College vote. So in essence, this is a block voting system, and whereby all the electoral votes within each state are assigned to the winning candidate by way of that state's popular vote. And the number of electoral votes assigned to each state is roughly proportional to the population of each state. Occasionally, as in 2016, this can lead to a candidate winning the presidential nomination, yet actually coming in second best when the national vote count is tallied. And this process happens in every state except 2, which are Maine and Nebraska. And they allocate their electoral votes to the winner of each district there. Washington, D.C. has 3 electoral votes, which are allocated to the winner of the popular vote there. All right, so all well and good. So how does the math work? So in the 50 United States, there are 435 congressional districts. Each state has 2 Senate seats for an additional 100, and the nation's capital, Washington, D.C., has those 3 congressional districts. And that makes for a total of 538 electoral votes. In order to be declared president-elect, the winner needs a simple majority of 270 electoral votes. So, and this is not news, it is an incredibly contentious election here. Yes, the Democrats lead in the polls at the moment by roughly 10%, but this was also true for Hillary Clinton in 2016, where she lost the Electoral College vote by 304 votes to 234. So here's our map of how we expect this election to play out. And just to explain what's going on here, the red represents safe Republican votes, and the blue represents safe Democratic votes. And the outcome of this election is anticipated to be determined by the swing states, and they're represented here in gold. The number by each state represents the electoral vote the electoral vote total for that state. By the way, this map actually visually looks mostly Republican, but that's only because the number of red states, especially the ones to the north, have far lower population density than states elsewhere in the nation. And so, for example, towards that upper left corner of the map, the combined population of Montana, North and South Dakota, and Wyoming is only about 3.3 million people, but it represents 12 electoral votes. Washington State on its own in the top left corner, by contrast, is home to about 7.6 million people and also represents 12 electoral votes. All right, so where do we stand right now? Let's take a look at our battleground states. Basically, these 12 states will likely decide the outcome of this election. And there's a couple of things I'd like to note. First, the polls at this point are indicating that this is shaping up to be a convincing win for the Biden camp. However, polling data in 2016 showed a similar picture for Hillary Clinton, yet most of those states ended up in the Trump camp. I'd be somewhat skeptical of the polls. Secondly, the margins in many of these races have been narrowing over the last few days in favor of Donald Trump. So momentum does appear to be moving back towards the Republican camp. There's a few other things going on too. Because of the pandemic, expanded in-person early voting and vote by mail has added another dimension in trying to analyze the outcome of this election. And so far, nearly 70 million Americans have cast their vote, and that is already surpassed the total 58.5 million total from 2016 for the early vote total. Approximately 2/3 of the early voting has been cast by registered Democrats, while it's anticipated that more Republicans will cast their vote at polling sites in person on election day. So an early lead by Democrats may well be eroded by voting on election day itself. Of these battleground states, Texas, really interestingly, is in the mix for the first time since 1976. This would be a huge win for the Democrats and almost certainly would end Donald Trump's re-election bid right there. With a surge in COVID-19 infections in Texas, it appears that the election there actually has become more of a referendum on the response to the pandemic. For example, El Paso, which is a city of 700,000 inhabitants on the border with Mexico, has in the last week imposed a curfew as virus cases there are threatening to completely overwhelm the healthcare sector, hospitals. Looking at Florida and Pennsylvania, as in 2016, again, it looks to be critical for Trump to win both these states with the 49 electoral votes on offer. Pennsylvania, however, is Joe Biden's home state, and they've been campaigning aggressively throughout the state in the last week. So a loss in PA is also a huge blow to Trump's re-election hopes. So the other thing that's going on is going to be pretty critical here is the Senate, and this race is really going to be important. If the Democrats can pick up a net 4 seats, they will regain control of the Senate. With 35 of the 100 seats on the ballot this time around, and 2/3 of them are Republican, there's actually a real possibility of this happening. So along with a Biden nomination, this would give Democrats a unified government and a mandate to really be able to enact their agenda. Conversely, Republicans are absolutely desperate to hold on to the Senate majority, especially if it turns out that Trump is unable to retain the presidency. So, really pay attention to this Senate race. It's going to be very important. So looking back at 2016 again, what can we learn from this? Price action around the election on election day, on election night actually. In 2016, we saw an aggressive sell-off in stock market indices and significant weakness in the dollar in those first 4 hours or so after it became apparent that Trump was going to cause an upset. However, by the time the markets opened in New York the next morning, markets had actually already recovered most of the sell-off and ended that first post-election trading session at the highs and then continued higher into the end of the year. As traders, we really should be thinking about how volatility will impact how we manage our capital and the level of risk we're willing to take. And really don't forget that having no position is absolutely a valid choice. So market positioning pre-election, price action is kind of indicating that the first stimulus package has been positive for equity indices and negative for the dollar under a Trump administration. But since the highs that we saw at the beginning of September, things have become far more uncertain for a couple of reasons, I think. A second wave of COVID-19 infections has appeared, and obviously market focus has now shifted towards the election. So we've seen a significant pickup in volatility, and the sharp sell-off in the last couple of days indicates that investors are actively reducing risk ahead of election day next Tuesday. And while market volumes have remained more or less steady, we are seeing an increase in daily ranges, and that also suggests that liquidity is starting to suffer. So what does this all mean? 4 major scenarios that we see. The easiest one, obviously, a delayed election outcome is unequivocally bad for equities. It'll be supportive of bonds and probably would lead to selective weakness in the dollar, especially against the yen. Gold and precious metals would also remain well supported. The degree to which this weakness persists will obviously be determined by the length of delay in announcing a winner of the presidency. These other scenarios are only our best estimates of market reaction for a given outcome. So a Biden win, but without the Senate, would limit Democrats' ability to pass new laws. A corporate tax increase would not pass with a Republican Senate, so this should ultimately be supportive for global stocks in the longer term. Against that, the size of the second stimulus plan will be key to providing adequate support for individuals and businesses in the near term. The Republicans will probably be reluctant to agree to a larger package. On balance, the short term should be mildly supportive of stocks, maybe accompanied by a measure of dollar weakness. A Democratic sweep or blue wave is this holy grail for the Democrats, and it gives them the strongest mandate to enact their agenda. In the short term, we think it will be positive for financial markets because we'll get an aggressive second stimulus plan and accompanied with an increase in spending on infrastructure projects and green energy projects. It does remain the question of timing on a stimulus package. Will enactment have to wait until after inauguration, or will the existing Republican Senate capitulate and actually pass Democratic measures? Tax increases and increased regulation down the road, though, are a potential negative for markets, but they're not expected to be the initial focus. And finally, a second Trump term would most likely maintain the status quo, which should be generally friendly to the stock market with continued deregulation. It's unlikely that Trump would get much cooperation from the House, much as we've seen in the second part of this last term. So policy will predominantly be limited to action via executive order. It then, of course, puts global trade issues back in focus, especially with China, be a source of potential road bumps, and increased debt could ultimately affect US government debt ratings. I'd also be looking for signs of a weak dollar trend to reemerge. So moving on, in this election cycle, there's so many additional uncertainties brought on by the global pandemic. Vote by mail is a major factor this time around, with about half of the total electorate receiving their ballots this way. Early voting is also being extended in many areas, and further exacerbating the issue is that individual states set their own rules for how and when these early and mail-in votes can be counted. Some stipulate that ballots received by mail cannot be opened until the day of or after polls have closed on election day. And this is likely to cause a delay in compiling an accurate tally due to the sheer volume, labor intensiveness, and certification process of a manual count. At least 4 of the expected battleground states do not allow ballots to be opened before election day. So there's a very non-trivial risk that a delay in announcing a winner could last days and potentially weeks. If the count is particularly close in a given state, it could lead to an unresolved litigated vote well past election day. And this scenario actually happened in Florida in 2000 between Al Gore and George W. Bush, where it took more than a month for Bush to be ultimately declared the winner. So not difficult to see a similar scenario playing out this time around. And any delay in declaring a winner or escalation through the courts will only lead to increased volatility. It's such a highly polarized environment, this election cycle, that it seems likely we're going to see a much higher voter turnout. And in fact, it could actually be the highest voter turnout in over 100 years at potentially 65 or even 70%. And just for reference, in a normal election cycle, we'd expect to see only around a 55% turnout. So this is lining up to be a very big deal. And finally, Amy Coney Barrett was confirmed earlier this week as the 9th Justice to the US Supreme Court. So we now have a decidedly conservative 6-3 balance. And this is going to become very important if any of the election results end up in litigation and ultimately make their way to the Supreme Court. So much going on. It's going to be a very interesting period next Tuesday, and but a few days after that as we get those results coming in. I'm going to hand off to Maurice now for a discussion on gold as an alternative investment. Thanks very much for listening.
Well, thanks very much, Nick. Really great to get an insight from a man who knows, who lives in the that political arena, to sort of suggest what we can look forward to. And as far as I can see from all he's given us, strap yourselves in. It's going to be a choppy ride. You know, it's a convoluted issue that we're looking ahead to. You know, for me, I want to talk tonight a few, you know, having got Nick on song with the what's going on with the election. I think people are looking around to see, you know, what they can invest in through this, and we need to look at possibly gold as an alternative investment. It's been something that's been going on for quite a while. So let's take a look at some of the basics on this and why it has been seen as an alternative investment over the last sort of year or so, because it sat in the doldrums for quite a while. So what's changed? So what we have seen is that we've moved into a world of increasingly negative or zero rates. Now, the thing about that is that gold becomes an alternative investment when central banks are not only debasing their own currencies by slashing rates and actively involving themselves, socializing their bond markets. But the point is that, you know, when rates come down to zero, then something like gold that has almost no yield at all becomes quite attractive if you're getting minus 0.3% in the EU. So what we have seen is that gold tends to do well when central banks turn extremely dovish in the face of slow growth and in times of crisis, and they slash rates to zero and do this massive stimulus packages, monetary stimulus package that is, and that sort of is seen as debasing currencies that hold less and less yield. So what people look for is alternatives. We've seen gold and indeed some of the like the likes of Bitcoin and things like that do quite well recently, and that's because there is no yield to talk of anywhere else and people are looking for something different. So what we do see though is gold does often provide us with something of an insurance against the unknown, and so therefore what we've seen is when people are looking for an alternative, we've seen some of the big players, that's the central banks and hedge funds, are actually accumulating gold over the previous let's say, I'd say 2 years that we've been going through this. So some would say since 2008, but it was a slow start, but I would say that's probably right. But it's become more into focus when the Fed actually started lowering rates down close to zero as well. I think that was the big turning point for gold for me. So low interest rates globally, something of a safe haven in some aspects, but we need to be careful here. We need to understand the gold characteristics. And the first thing is it has a zero yield. So when currencies were when you could get invest in the US and you'd get 3%, or if you're investing in the UK and you'd get 5% back in the day, salad days they were, gold had little value really to be held as an asset because it yielded nothing. Basically, you just hoped that the capital increase would make you a profit, and quite often it didn't. It either went up and came down or stayed down. So it wasn't really seen as an investment of value. That's changed, to be honest. And I think that, although now it doesn't pay the investor anything to own, a zero yield is better than a negative yield. Now that has to make sense. So you can see why the attraction is there. And also I think with the fact that currencies are not based on a gold standard anymore, they're based on trust or faith, if you like. I think central banks particularly and governments have wanted to own gold in their reserves just in case that faith is lost. So I think that is why we've seen this sort of investment strategy from the big players like central banks. The risk to this, of course, is that gold does not have the liquidity or depth of FX markets or bond markets. I mean, the US bond market is the deepest, calmest, safe haven out there, and forex you can get in and out very quickly. The problem is with gold, particularly futures rather than physical. I mean, if you buy gold and you take delivery and you keep some gold bars. You can buy these, 100-ounce bars or 50-ounce bars or whatever. You can put them in your safe, and you can literally invest in them that way. Futures, it is seen that futures can actually, we've seen this with oil. They can actually lose sight of the underlying. So we need to be a bit careful with futures. I think physical gold is probably the way to go for most smaller investors like myself who would just have the odd small bar in the safe as such for a rainy day. I think trading futures they're very erratic, and I'll come on to the risks and show you some of the risks in a later slide. Nothing is perfect, and following the pandemic, we've seen a couple of issues that you can see on the chart that's coming up in a second, where we see quite a nice structure. What we saw here, we saw gold starting to rise from January the 1st to March as uncertainty and fear grows. We saw a nasty dip down, as we saw sort of margin calls, when China went into that dramatic lockdown, and we thought, oh my goodness, the world's gonna stop here. As equities got hit rather hard, with all the margin calls that went out for all the other assets, people had to sell their gold positions to pay for those. So there, you have to realize here, and this shows us very clearly, that in times of stress, gold doesn't always look great as an alternative investment. Sometimes it follows everything else. But what we did see as we got through that, we saw gold resume its trend back higher as stocks turned around, and we saw the massive stimulus coming from the central banks. And gold seriously responded to that stimulus. So that pushing of rates, interest rates down to zero, particularly from the Fed, when we saw everything else pushing down, we saw fiscal stimulus as well, trying to boost these economies, trying to help it out. But gold was a real performer over those sort of 6 months. Then we've seen situations where we get an acceleration into the highs, we get a peak, and then we get some pretty violent moves back again. And I think, those red bars just after that box show you how extreme some of these reactionary trades can be. And you can see that actually created a high in gold that we haven't seen since. We've had a kind of a sideways movement since, because we're unsure what the dollar's going to do here. We have seen a bit of a rise in gold when we get a little bit of positivity, but then it's uncertain. We haven't got a relief package from the US. We've got a US election coming up. What's that going to do to gold? There is a danger here that it can at times, as you can see in these red boxes, it can follow risk markets. So we need to be careful. If we get a big sell-off in equities through the election, or even like on days like today, we do often see gold weakness, because part of the factor that drives gold is the dollar, and with a higher dollar, we often see commodities and gold lower. So we do have to bear that in mind. It's not a straight run, this. It's not an easy run either. There are bouts of real volatility in gold that I think need to be highlighted here. It's not a one-way bet. It's not a pure science as an alternative investment. So if we look back at 2016, I really like this graphic because it shows you over the election that we saw a $70 spike in gold on the Trump win. Stocks sold off about 5%. The Trump win was a surprise, and as that went on, I mean, that people just didn't know what was what, and so for safety they turned to gold. But that rally seriously didn't last very long, and look what happened. You know, within a week these moves had been erased and stocks were back higher, and you'd expect what to say, well, hold on a minute, then maybe gold is going to do really well. And all we saw after that was gold go down. That was the high in place. So we've had a few issues here where you can get some real volatility in gold, and it is quite a dangerous market. So thoughts for this time around. I guess if Trump wins, I think the markets are pricing in a Biden win at the moment. I mean, the polls are suggesting that. I mean, whether they're right or wrong, I think the market is beginning to price a Biden win. The market seems to think that's positive because he's going to give us potentially produce the stimulus that's needed for the US economy, but it's not clear. That would send dollar up, I guess, and gold would struggle, I think. A Biden win could mean more stimulus and gold up, but for me, it depends what kind of win. The problem I have with this, and you know, it was alluded to by Nick really well today. You know, there's danger of a split. If the Republicans hold on to the Senate, I think that's really quite important, because the issue for me is then passing anything is going to be a lot more difficult for Biden to get through. He may not even be able to get his stimulus through as he wants it, because, you know, we could have what we call a bit of a lame duck government for a while, you know, for quite some time, if the Republicans want to dig their feet in. So it's not clear how this is going to pan out for gold, but certainly we have seen over the past 3 or 4 years a constant build-up of reserves at you know, the big sovereign nations trying to build their reserves. We've seen central banks sort of buying gold. We've seen hedge funds buying gold. We're a bit sideways at the moment, and I think we're at a bit of a crossroads for gold from where we go. And I think we may get more clarity just after the election, depending on what the outcome there is. So the market, what's the market positioning? On gold is probably a little bit long. And if we do start seeing a bit of a drop down from the election, then we need to be a little careful here. One thing is clear: we're going to have volatility through this election for all markets. And if you look at the VIX, the fear index that we've spoken about many times, you know, that is elevated up around 38 at the moment. Anything above 30 means high risk. You know, and look at what we've seen in stocks today. So, you know, it's not a clear picture for gold. There's a lot coming up that's going to keep markets very volatile. And I think we need to look at where markets are right now on a broader base. So where are we? Well, right now, if we look at global economies, I've got a few things put down here on the left. I've highlighted just 2 things, but do look through these. The increasing number of virus cases in the US, EU, and UK are becoming a massive impact on markets, because these are beginning to have a serious impact on these economies. So, you know, France, I think Macron is speaking, as I am, talking about potential national lockdowns. Germany are talking about lockdowns light, if you like, closing certain areas. And the UK is obviously still on the case with targeted lockdowns. These are going to hit these economies, and they're going to hit the employment levels, which we'll talk about later. And I think we need to be really careful about bringing this back onto the radar, because these do have economic impacts. And I think that is why stocks had a wobble today, and is why realistically that there's some real nervousness out there in the markets as we head into another uncertain area of the US election. The US virus relief package, I mean, Pelosi keeps talking and talking about hope of a deal, blah, 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 blah. I'm not buying it. I don't think there's enough time to get that done in front of the election, so that's over. That means, when do we get the stimulus that the millions of unemployed people in America need badly? A lot of these packages have ended or are about to end. There's a lot of people suffering now. They spent a lot of the money they were given. We saw that through retail sales. The economy is now going to have a bit of a void of spending, and that could start showing up in fourth quarter data. Data at the moment is looking pretty good out the US, but I just fear that they're 2 or 3 weeks behind what the EU is going through. So we need to be careful here. Viruses are still rising exponentially across America, and I think that's going to become more of a headline going forward. Governments, well, chief negotiators, you know, they've gone a bit quiet. They're supposed to be talking into today. I haven't heard much on this today, but I think they're going to move into Brussels tomorrow. They need compromise. They need some good headlines. But sterling has actually, you know, performed relatively well against euro and a few other things. So, you know, we need to get some clarity on exactly how those are going. A couple of points highlighted here. You know, I've put in bold here: suggestions over mixed over progress, which is now being pushed back to PM Johnson and Commission Head von der Leyen. They need to really get something done. I think we need to get Merkel involved. I think we need to get something on paper that says, right, we're now in the last phase of this. Otherwise, I think sterling could start coming under some pressure. China, we mustn't forget that the Chinese-US trade war is still on. There are some major implications being built over the arms sales that the US is giving to Taiwan. That is seriously upsetting the Chinese, and I think the relationship between the two is souring badly, and I worry about that. It's these two countries, these are two superpowers that are polarizing. As they drift apart, the danger of a Cold War like we used to have with the Soviet Union grows, which is not good for global trade. It's not good for supply chains. It's not good for the global economy, and therefore not good for stocks, because a lot of companies are global, and you know, there is an impact from this. So I think we need to be very careful about the impact of this. The trade wars have not gone away. You know, no change from the BOC, and that was predicted, so nothing really to talk on that. So the ongoing pandemic employment problem, I want to bring this slide up to you because this is a US chart that shows you that the number of unemployed over 15 weeks who are looking for full-time work has spiraled. Now, yes, claims were better. Yes, non-farm payrolls weren't as bad as expected, but the longer-term unemployed and the redundancies are climbing across the developed world, and this is for the US. And it just shows you that this is long-term unemployment that's starting to happen. They want full-time work, but there are 2 people looking for just about every job out there. So this is a problem that's not going away. Now, the psychological impact of high and longer-term unemployment on the psychological or psyche of the consumer is quite high. Even if you've got a job and your friends are losing them or your families are losing jobs, it hits your attitude towards confidence and spending. And I think we need to be careful of this. US GDP data is expected to knock it out the park on Q3, but that's backward looking, remember. We need to see what's going to be happening into Q4 and into the start of the new year. So on that basis, we can start looking forward at the markets now. So we are just 6 days away from the election. Nick's given us a great rundown on that. Fireworks, basically. It's going to be a lot coming out. I think market volatility is definitely a factor. We need to be very careful here. I think there is going to be wild swings in markets, both up and down. I think all asset markets, all asset classes are going to be impacted by this. And, you know, the fear indicator, the VIX, which we've told you to put on your screens, keep an eye on that. If it stays elevated, then we're going to have to be in a situation where a professional trader like myself would de-risk, if you like. So I would have less exposure to the markets because I'm going to have wild swings. So, you know, if you're going to put a 20-point stop on a, you know, on the euro, you're probably going to get done pretty easily. So put less in and have your stop 40 points away or something like that. So you need to de-risk, de-leverage, as we call it, and trade what's in front of you. You know, these market swings are going to be irrational at times because there's going to be a lot of headlines over the next few weeks. So, you know, this is about trading sensibly rather than looking for the big bang, the big run, if you like, in one hit. It's not going to happen over the next couple of weeks. You may get lucky, but trade so you keep some powder dry. The EU is an interesting one. We've got the ECB tomorrow. They're going to be talking about rates. They're not expected to do anything tomorrow, but give us a heads up for a potential increase in their QE program in December. But why wait? I ask myself. I mean, things are looking pretty bad in the EU. And where is the EU virus relief package that we've been promised? I mean, the fiscal stimulus from the governments, this is money they can put directly towards the consumer. Where is that? What worries me about the ECB at the moment is that their additional QE makes them sound rather like the Japanese, throwing money after nothing. I mean, what is QE going to do to anybody? What are lower interest rates going to do for the consumer? Nothing. You know, they will sort out liquidity, but they won't sort out solvency. And you know, a lot of companies going bust at the moment. There's nothing the ECB can do about that. And unemployed, there's nothing the ECB can do about the unemployed. QE is not going to save the unemployed. So, you know, with the virus package, relief package in the EU and the virus package in the US, these governments need to step up, stop playing politics and get the money into where it's needed. And it's not happening. So again, that's why we have a bit of a wobble in stocks at the moment, because these things are just not coming. Thursday is going to be a very interesting day on top of the ECB, as we have Amazon, Apple, Google, Facebook, and Twitter all announcing their earnings. It'd be interesting to see what they come up with after the nearly 3% hit to those today. You know, some of these were down 4.5% today. These are stay-at-home stocks, though, so we believe they should have done pretty well. So it'd be interesting to see if this turns markets at all. But you know, if we don't get a decent bounce, it's going to show something is pretty bad in the market, and that people are keen to book profits. A lot of people do feel these stocks are overvalued and they need a bit of reset. I'm not saying they crash at all. I think there's, you know, I would probably be interested in buying on a dip. Where that dip is, I don't know, but maybe there's some more profit taking to be taken in some of these markets before we find a base. But it's going to be a very interesting day tomorrow. High volatility. A lot of these guys announce their numbers after the close. So that's going to end up for a very nervous Friday, I think. As I say, the China trade war is not going away. But on the currency markets, euro has been suffering. You know, further lockdowns. I think this has hit the euro as well as European stocks. What we've seen here is, I think, capital coming out of the EU, EU markets. You know, the DAX, the CAC, the Spain, Italy, they've all got serious lockdown issues coming up. And I think the market is coming out of there, looking to places like Korea, China, certain other Asian economies that seem to have got past the worst of this. And I think the money is being drawn out. And that's why I think there's a danger that the euro stays rather weak. We may even see further weakness from here. 116.88 I have as a, Richard will talk about this later, but I have as a bit of a level. You know, it's holding at the moment. If we break that, then I do think we have a bit of a game changer on the euro. You know, ECB tomorrow, if they're extremely dovish or they surprised by actually doing something at this meeting rather than next, that could be euro negative. So we need to sort of keep an eye on what comes out of that. US data also has been better than EU data by some margin, so that also could weigh on the EU on the euro, beg your pardon. And you know, as dollar rising as stocks fall, which is risk off, could impact commodities and gold, as we've spoken to. A higher dollar in a risk-off environment can often hit gold, oil, and commodities. So we've seen some good rises in those recently, particularly copper and a few other base metals. But these could come under real pressure if the dollar does rally significantly. We've not seen a big move in the dollar, to be honest, over the last couple of days, considering the sell-off in stocks, which I'm slightly surprised about. And certainly the Aussie has held up very well in this. I'm amazed we're not back at 70 cents. particularly seeing as we're sort of moving into the central bank meeting in Australia on November the 3rd, which is the same day as the US election, of course, where they're talking about doing possible rate cuts and more easing. So quite a lot coming up, guys. You know, it's going to be interesting. Data is still hugely important. You need this stuff on your calendar. You need this on the screens in front of you. For me, the highlights are in red here. The big ones for me, again, always US initial jobless claims every Thursday, high frequency data. US GDP is going to be big. It's going to be third quarter GDP though. So just bear in mind that this is backward looking. It's going to be good. It's after the lockdowns. It's almost after the enforced coma, if you like, that we saw. This will be the knee-jerk reaction. It's going to be record breaking, but you know, markets look forward. They don't look backwards. ECB interest rate decision, clearly a triple star event. Not expected to do anything, but again, my point is, why wait? I mean, you know, they're looking at deflation. They've got a strong mandate to stop inflation falling. So why wait? So maybe we might get something that would be a bit of a shock, but certainly at the very least, I think we'll get a heads up for more action coming. Friday, that's going to be an interesting one. I think European CPI, for me, the inflation data, it comes after the ECB meeting, but I think it is crucial for them. If that's weak again, then I think we could see Euro struggle a bit. Euro GDP, I'm expecting that to be good, but again, it's third quarter, so don't be fooled by that. I think US personal income and income and expenditure are big numbers because the Fed looks at these. Obviously, consumer income is massively important. We get the spending data in there as well. Be interested to see if that's starting to roll over. And then, of course, the consumer sentiment in the afternoon. So all I can say is that we've got high volatility. We've got a lot of stuff going on. You're going to have to keep everything in front of you. But don't forget, even if you're trading like I do on more fundamental structures, you must use your timing. And that means using, as I do, technical analysis. And to be honest, there's no one better than Richard Adcock to take you through some of that. And I'm going to pass you over to him right now. Cheers, Rich.
Great. Thanks very much, Mo. Good evening, everybody. Welcome again to another week. As I've said over previous weeks, there's sort of three areas within technical analysis that I think are the most important areas to concentrate on: momentum, trending, and sentiment. We looked at sentiment last week with various sort of candlestick type scenarios on a daily basis. And this week, I just want to touch on momentum, and in particular stochastic momentum, which is what I think is one of the better momentum indicators. But as with the majority of technical indicators, there are a number of momentum-based indicators available on any charting system. And obviously there are time constraints with us this evening, so I'm only going to touch on what I think are the most interesting and what I think are the most popular and most used indicators, and to give you an idea of what I think and how I view them. So I'm going to concentrate on the RSI, the Relative Strength Index, and stochastic momentum. Now, some people will class the MACD, the Moving Average Convergence Divergence Indicator, as a momentum-based indicator. Now, I question this because it's a moving average-based indicator, so I think it's more of a trending signal, and that's certainly how I use it. So I'm not actually going to comment on the MACD this week. That'll be next week when I look at trending indicators. So I'm just going to concentrate on the top two and look at the good things and the bad things about momentum and how we can gauge a timing signal by using momentum indicators themselves. So uses of momentum indicators. Well, basically, obviously momentum, the speed of market moves. It allows us to judge the pace of price action, and it allows us to gauge how significant that speed is behind any particular move. And obviously, the faster the move, the more significant the sentiment, and the more significant it is for us to either be sort of judging the directional move of that potential and taking advantage of that as early as possible, And this is where momentum also comes into play in highlighting turning points within markets and giving us that timing aspect as to when we need to concentrate on price action more closely and to actually trigger new trading opportunities by using the momentum-based indicators to give us that timing aspect. Probably the most use for momentum indicators, and one I personally would question, is to highlight overbought and oversold conditions in the market. Now, overbought and oversold readings are a bit of a holy grail within technical analysis. You know, if somebody starts talking about something being overbought, it doesn't necessarily mean that we're going to correct and sell off from that point. You need to be aware of certain aspects within the market. And this is where it sort of comes into the good, the bad, and the ugly, if you like, of momentum. The good things are that momentum indicators react quickly to price action. They're designed to give us earlier signals than the slower trending indicators, such as the MACD, such as the other indicators. They can give us great timing signals because when they move earlier than other indicators, they will give us an aspect of an early signal to actually generate new trading signals and when we need to be entering the market either to the bull or to the bear side. They flag the speed of price movement is slowing. They highlight divergences. So often when you see prices make new highs, if you see a failure by momentum indicators to confirm those new upside extremes, you have what's called a divergence. So in other words, the current speed behind the latest price strength is less this time than when we were previously making the highs, and that is a warning signal of divergence. It's the potential for a sign of a turning point within the market. What I would need to say at this point, though, with divergences, you have to see breaks below the last correction low in price to confirm it. And just because price have made new highs and momentum indicators haven't, that isn't the divergence. You need to see confirmation by breaks of the last correction low to confirm that directional change. Momentum is best in sideways trending markets. And this is why we need to be aware of the trending condition of the market. So overbought and oversold will work best within a sideways trend, not in a trending condition. And this is where we have to know the market trend that's dominant within at that particular time to actually gauge how we should be using momentum indicators. And the important thing to remember is that in trending markets, overbought and oversold conditions should be ignored because the chances are that sentiment is such that we will continue that ongoing trend no matter how overbought or oversold the market actually is. So what I mean by that is that we need to know the trending condition of the market to highlight whether or not we should be taking notice of overbought or oversold readings. And with that in mind, if you remember, we've looked at the Euro-Aussie as a sideways trading range. And this is the RSI indicator, the relative strength indicator. Now, effectively, this takes the average up moves against the average down moves over a 9-day period. Now, that period can be a 14-day period, which tends to be a default setting. If I use the RSI, I tend to concentrate on a 9-period setting. It just gives slightly earlier signals and slightly more reliable signals. But what we need to bear in mind is that the RSI in particular is only best in sideways trending markets. I wouldn't use the RSI to highlight an overbought or oversold market in a trending condition. And the reason for that is that certainly when you're in a sideways trading range, as we have in the Euro-Aussie up until recently, you can see that an RSI below 30, a break above that point, or a move towards 70, or a break below that level having been above it, would reflect an overbought, oversold reading within that sideways trending condition. So in other words, when the market's moving sideways, overbought and oversold is a valid measure of price action and a reasonable signal for when turning points are likely to be seen within price action. However, if we look at when the market's trending, and as we see the movement in Euro-Aussie into that sideways trading range, we were seeing a more aggressive downtrend condition. The oversold readings weren't reliable. All we saw was as the indicator broke back above the 30% level, we saw a limited recovery within the market before the bearish trend continued. So we still had the dominant trend being to the downside. Sentiment was such from candlesticks to continue that negative theme and prices to continue to push to new lows, even though we were hitting oversold readings. So overbought or oversold, and you can see overbought examples within this upside move, overbought or oversold conditions are not reliable when the market's trending. And this is why I would use the momentum-based indicator alongside something like a trending indicator, the MACD or the Bollinger Bands, which we'll look at in a second. But it's well worth keeping that in mind, that you need to know the trending condition of the market and whether or not to rely on overbought or oversold conditions. Now, the slow stochastic is probably the most momentum-based indicator that I use. In all of my analysis, I use the slow stochastic over the RSI, mainly because you get a turning point within the indicator. So in other words, the indicator line, which is the blue line here, and the slow stochastic takes the average current level in relation to the range over the last, well, I use a 10 period together with a 3 moving average. So if you input that into the charting system, you put 10, 3, 3. There are other default settings, but again, I just tend to find that these are the more reliable and to give me the types of signals that I would be looking for. But again, within a trending condition, even the slow stochastic is not that reliable, because basically we would look at an upturn from an oversold reading within the slow stochastic, so the indicator line breaking above its moving average, as highlighting an oversold reading and risks turning back to the upside. However, if you're trading in an aggressive downtrend, the chances are that these oversold readings and these turns higher within the indicator will be ignored. So it's not necessarily the upturns that we're looking for within a downtrending market. It's more the fact when momentum turns lower again, because that actually signals a re-acceleration of the existing downtrend. So how do we measure the trending condition? Well, we've already looked at Bollinger Bands, so we can use Bollinger Bands as an indication of how the market's trending and how we can use momentum-based indicators within that situation. So if we have a sideways trading range, so the Bollinger Bands are parallel, then we would take more notice of overbought and oversold readings. So upturns in the indicator or downturns in the indicator would be more significant within a sideways trading range. And we could have that with the moving average more or less flat and the bands themselves parallel. However, when we start to see the downtrend developing, so the moving average turning lower and the band starting to widen, we have a confirmed aggressive trend. So the upturn in the momentum-based indicator when we're trending, in this case to the downside, is less significant than when we're in a sideways trading range. So I would actually ignore this upturn because we're still in an aggressive downtrending condition. So it's more the fact of when momentum turns lower, no matter where it is within, whether it's an overbought, neutral, or oversold reading, if momentum turns down within an aggressive downtrend, reflected by the widening bands and declining moving average, then we have a significant signal to re-accelerate that downtrend. So that for me would be a very significant development within the market, as would if we start to see momentum turning higher within a positive trend. So if we have a confirmed trend, then we know to ignore overbought or oversold readings. So it's more the counter, the confirmation signal of that trend from momentum that is significant. So a downturn in an aggressive trending condition is a negative signal. Momentum turning up in a downtrend is more of a consolidation, but it's the fact that when momentum turns lower, that's the significant development. Okay, so that's how I tend to sort of look at momentum. I prefer to use the slow stochastic over the RSI because it gives you that turning point. It gives you that trigger point for the actual developments within the market. And that's why I tend to favor stochastics over the RSI. So we're going to have a look at the US-based markets now ahead of the election and what we're actually beginning to see from a technical perspective. And I must say today is very interesting for equity markets, basically because we've been very cautious of equities over the last couple of weeks. This is a weekly chart of the S&P. We've seen neutral trending conditions within candlesticks. So open and closes have been very close to each other. We've seen rejections from highs. So in other words, sentiment has been turning more negative, or at least consolidating within the upside move, with the risk for this reflecting a failure to break to new highs and any new failure set to see further pressure build. Well, we can see that this week's action so far, we've opened on the high of the week and seen nothing but selling pressure. So that in itself is a negative signal in terms of sentiment. The first opportunity to trade this week has encountered fresh selling pressure and the market sold off. We're now trading below the mid-average of Bollinger Bands, which we held a few weeks ago. And you can see that normally, once we start to break below this mid-average, we could see acceleration towards at least the lower band of Bollinger's and the risk of a more extending sell-off. Now, if we look at the daily chart, we can actually start to see that the daily Bollinger Bands, not only have we broken below the mid-average, that's now started to turn lower, and the bands themselves, with today's activity, are beginning to widen to reflect negative volatility developing within the market. Now, the important signal in terms of support is this last correction low. So if we start to break under this level, the risk is that we would be seeing a much more significant deterioration. That point stands at 31.97. We would call this, in traditional analysis, a double top. So if we start to close below that low, the potential is that this is a distribution area. The market's failed to make new highs, as we've previously done since March. And if we then start to break below this last correction low, it would reflect deterioration. So over the election, if we start to see this point give way, or even coming into the election, we start to see this support point give way, it would reflect a much more significant deterioration for equities and the risk of a more extended retracement of this upside move. Similar to the picture with the NASDAQ, although at the moment, this is the weekly chart, we are still above the mid-average. So that is still a support focus. But if the NASDAQ starts to break below that level, we have again a very similar type of potential reversal pattern building where we've recovered, attempted to break to new highs, but rejected it. And as you remember from last week, that sentiment measure, the fact that we have those lengthening shadows and the open-close relationship towards the lower limits of the week's range, highlights the potential of a sentiment change. Last week, we saw a negative move, and this week so far, we're seeing a more significant sell-off. So again, if we start to see this mid-average give way, it would reflect deterioration within the market and the risk of a more extended sell-off. Now, the daily chart reflects that negative themes beginning to develop. Obviously, with today's aggressive sell-off, we're starting to see increasing volatility developing, with the mid-average beginning to turn lower. Again, the important support is this last correction low around the 1066.63 level. But if that starts to give way, it would reflect continued deterioration and chances of a much more extended decline for equity markets. The Dow is already back to its last correction low. So we're trading around that point at the moment. So again, a close below this level would reflect a much more significant deterioration within the outlook for the Dow Jones. And that would suggest at least a sort of retracement point towards the 24.9661 level, or to the 50% level at 23.653. So again, this is a support point to watch on a closing basis, but if that starts to give way, then the risks are for a more extended sell-off to occur and the potential for a more prolonged bear phase developing. So they're the focus points for equity markets coming into the election. We would really need to break these recent highs to suggest a much more sustained advance. So at this stage, the negative themes are beginning to gather pace and perhaps start to outweigh the more positive activity that we've seen. So that's the equity markets. Looking across to the dollar, really, you know, as Mo's mentioned, there's not a great deal to really talk about at the moment for the dollar. The equity weakness is seeing the dollar finding support, and that's seeing some confusion to a certain extent within the technical backdrops at this stage for dollar crosses. Euro dollar, for instance, you can see is still choppy sideways trading range. We would effectively need to see a break below this low around the 116.84 level to suggest a more significant deterioration, or breaks above these previous highs, which have held recently, coming in around about the 119 figure. So you would need to see breaks above or below those points to trigger a more significant move for the euro US dollar. We've also got the euro concerns on top of that, which Morris touched on earlier. So that's adding to the uncertainty, the choppy conditions within euro dollar. The yen has been a big beneficiary from the recent activity, and you can see dollar yen is currently sort of trading within a more negative themes. We've consistently held below this mid-average. The support point really is this low around the 104 level. We start to see the 104 point giving way. It would reflect much more significant deterioration technically and the chances of a much more prolonged sell-off occurring. Cable as well, we've started to see tests of these support points, but it's not a clear-cut picture. It's more of the risks are that we could start to see more selling pressure developing. But really, for me, 128.65, which is this 62% retracement and last previous correction low, is the important point to watch to the downside. While to the upside, it is still really, it doesn't really sort of give you any sort of significant insight apart from I'm saying the previous highs and important resistance level. But really at this stage, we would need to see breaks above these previous highs to trigger a more extended dollar phase weakness and sterling start to perform really well, or to start to see pressure build to the downside as the US dollar continues to find support if we break these levels. So then just looking at finally the Aussie US dollar, we can see again this sort of choppy sideways trading range, but we've reflected, we've spoken about negative themes technically for the Aussie dollar, and they still are evident. We've seen a rally developing this week and to a certain extent last week, but you can see that the risk off trades, not only is the dollar a beneficiary of that, but also the Aussie dollar comes under pressure on the back of that. So you can see that we're again heading back towards this important low around the 70.07 level. And that for me is quite an important trigger point. You start to see that support level giving way, be it coming into the election or during a reaction to the election results, then that would signal much more significant deterioration for the Aussie and the risk of a much more extended retracement of this March-August advance with the 38% level at 66.78. So that would be the first support point if we start to break below this important low and the support level that's held now for some time. To the upside, it would still be this high that I personally, which also coincides with the upper extremes of Bollinger Bands, to suggest that we need to see a more sustained phase of US dollar weakness and attempts to break towards the new highs. So I think, you know, the themes technically, Chris, if you want to flip back to the main presentation, please. I think the themes technically at this stage are still Equities under pressure. The risks are that we could be forming significantly long-term reversal areas if we start to break those last correction lows. And certainly that would suggest that the risk-off themes would be pretty dominant following the election. If we do start to break the resistance levels, then obviously that would paint a slightly different picture. Certainly at this stage, coming into the election, if we did test those last corrections lows, personally, I would expect them to hold, at least for the first test, until we start to see some sort of significant news coming out of the election, and that will give us a guide to where the themes are actually likely to develop. But certainly if we start to see those points give way, the risk would be for a much deeper and longer term retracement of the strength that we've seen from March lows. And then looking at the dollar, still choppy decision making, no real clear bias at this stage. So there's a matter of seeing how these evolve and how this develops coming into and just after the election for where the next significant trends form. So that's the technical interpretation. Just leaves me to hand across to Chris, who's going to deal with your questions. Thanks very much, Chris.
Excellent. Thank you, Richard. Thank you, Maurice. Thank you, Nick. Excellent content this week, especially when there's so much going on. So we have a few questions. Start with you, Nick, but I'm sure Maurice may have a view on this as well. If we start with you, in the election, do you think the narrower the margin of victory, either way, of Trump or for Biden, means more chance the election is contested in the courts, or we have a delay of the outcome?
So it's a little unclear what that was, but you're asking the margin of victory for either side, whether that impacts whether it would go to the courts?
That's right.
Okay, yeah, absolutely. There is hope that we can actually have a result on Tuesday night or early into Wednesday. But yeah, we'll need to have a pretty significant margin. I'm going to say that's going to be driven by probably 5% of the popular vote in each given state. So I think it will be uncontested if the margins are that great. Anything under that, Trump has kind of indicated that he will absolutely do what he can to get a recount and not accept the initial outcome. So we might be looking at pretty broad margins before it'll be accepted.
All right, thanks very much. If Biden was to get in, do you see him as more outward looking compared to Trump, who is protectionist?
Yeah, absolutely. Without question. Biden's a believer in free trade and global trade. I think we'll see definitely be looking to write negotiations with other countries. I think it will see an expansion. So that's how the Biden administration looks to build revenue, I think.
Okay, but do you still see them that they'll still have to deal they'll quite be severe in their dealings with China? Possibly not as strong as Trump is, but do you still think they'll have problems there?
Yeah, China's going to be an issue either way. It's going to be a bigger issue. I think that's correct. It's going to be a bigger issue with the Trump administration, but it's not going to be clear sailing for a Biden administration.
Okay, thanks very much. One for you, Richard. If you are a daily chart trader, then how do you see a range-bound pattern and use the stochastic oscillator?
That's a very good question. Thanks very much for that. You simply use something like the Bollinger Bands or a trending-based indicator. I would say that Bollingers are probably best for intraday trading rather than some of the other trending indicators that we'll look at in future weeks. And very simply just use the direction of the mid average together with the bands themselves. And if the average is flat, you're in a sideways trading range. So concentrate more on using the overbought, oversold conditions. Where if you're in a trending condition and the moving averages is showing you that directional bias, then say if it's showing a downtrend, if the average is falling, particularly if bands are widening, and then momentum turns lower in that situation, then that's a reasonably strong signal that you're going to see acceleration of that trend, be it on a intraday, daily, or weekly perspective. It's still the same signals and the same theories, no matter what time frame you're looking at. But I'd use a Bollinger Band together with the slow stochastics for those signals.
Thank you very much. One for you, Maurice. You talked about gold. Do you see if Biden was to win big, do you see gold rising again as the market gains more confidence for big stimulus?
Oh, you do ask some questions. Good questions, whoever put that forward. Gold. I would base that on the fact that if Biden has a big win and he wins both House and Senate, then I think gold would do pretty well. It's a view, it's not a recommendation, but I think what we'll see with both House and Senate in the short term, I would add, is that we would see possibly a risk-on move where equities rallied because on the belief that we get a bigger stimulus come through and fairly quickly, which would help the short-term market. But my issue here is I'm not sure how long that would last, because I would think that with both House and Senate, Mr. Biden might want to start putting some of his tax plans into operation, which are not particularly Wall Street friendly. So I think it may be a short-term, long-term issue, but I think the knee-jerk reaction to a strong win might be short-term positive for equities and gold and negative for the dollar, but I'm not sure how long that would last. I hope that's clear enough, but it's going to be a tough call.
All right, thanks very much. On the note of gold, I just happen to have that up on the Pepperstone system there, Rich. Would you be able to just walk us through your thoughts on gold for from a technical basis?
You used to be a Boy Scout. You're always prepared, aren't you?
There you go.
Yeah, no problem at all. I mean, we're looking at the daily chart of gold, and I think just looking at the overall perspective that we have at the moment is that we're still failing to break above previous recovery highs, and the fact that today's sell-off, again based more on the dollar moves that we've seen today, have broken lower, and we've broken the uptrend. Certainly if we start to put in something like the Bollinger Bands just to give us an idea of the trending condition of the market, we're sort of looking at, we're at lower limits. It's very similar to the activity that we're currently seeing within the equity markets on a daily basis, in that we've broken below the mid average, we're touching the lower band. Now, this lower band can be a support point, but the important level to watch is that if these start to widen, so in other words, we start to see increasing volatility within this sell-off and the bands start to widen, the risks are that you can see, I'm not saying it's going to be as dramatic as that, but the widening of bands, the increasing volatility, you can move at or alongside the upper or lower band. In this situation, it's the upper band. So if we start to see the bands widening, we can move lower. As I say, it's not going to be as aggressive as that move from what I can see at the moment, but the risks could be that you can track lower. And certainly if we start to see these lows give way, then that would signal a much more extended decline and potential retracement move. So then that brings on the current retracement points that we have in place, and they would be potential support points to the downside. So 1825, 1761, even if we start to see that point give way. The risks are developing to the downside, but if we start to see some more negative themes and these sort of trending signals turning negative, and with today's move, I'm assuming, I haven't seen the latest move, but I'm assuming that if we put these parameters in, and they're the parameters I was talking about earlier, so for the percentage K, use 10, percentage D 3, and the percentage K slowing 3. They're the setups that I use. You can see that momentum is falling as well. So momentum falling, if you start to see the mid-average declining, volatility increasing, that can still see pressure build to the downside from here.
All right, thanks very much. We had another question. Would you trade the crossovers on the stochastics or the bit in between?
Sorry, I missed the last bit. The crossovers or?
Would you trade the crossovers on the stochastics or the bit in between?
Well, it's the crossovers that are the significant signals. So, you know, the turning point. So if you suddenly start to see, for instance, we're in this sort of bullish trend, once you start to see momentum turning up within that situation, it's a fresh buy signal to either continue to hold or to increase risk within that developing uptrend. So each time momentum turns up within that confirmed trend, it's the crossover that gives us that trigger point and that signal to increase risk within this developing trend.
All right, thank you very much. Maurice, one for you. When should we consider investing in the Swiss franc? I'm assuming from a safe haven point of view. Could you explain that and what you come up against when you do invest in the Swiss franc at the lower level or the higher levels?
Yeah, it's a good question. I mean, we've had some safe haven currencies that have been fashionable over the years, and you know, to date, it's been the yen, it's been the Swiss franc, and to some extent the dollar. The yen has seemed to have lost that safe haven status. I think the yen is moving on many different things now rather than just risk on, risk off. I mean, its correlation with risk has been awful. The thing about the Swiss franc is that what you're up against here is the central bank at the Swiss National Bank that is against Swiss strength. Now, I think if you've got a view on the dollar, then being long Swiss is, you know, if you believe the dollar's going down, then long Swiss is possibly a trade for you. But I think that's a dollar scenario rather than anything else. I think if you look at Swiss against the euro or against many other currencies, it's not quite so clear. And I think that the Swiss National Bank is quite keen to keep a fairly stable euro Swiss rather than a dollar Swiss rate. And I think that's what they're keen to sort of keep trapped. So it's not a straight safe haven complex as the yen used to be. I think what's happened here is that the safe haven status has shifted towards the dollar. And so what we get is when we see a big sell-off in equities, we see the dollar rally broadly against many, including the Swiss, which takes the Swiss lower. But what we do see sometimes is that move in the Swiss lags slightly. So you do get something of a move in the crosses. It's not the safe haven of choice that it used to be because of the involvement of the Swiss National Bank, because they do intervene, and I think that needs bearing in mind. So it's not a clear strategy, that one. I think the safe haven of choice now on a big macro move, if we get something seriously happen, it is the dollar. I think that we still gravitate towards the dollar in risk off. There is a slight positivity within the Swiss franc amongst other currencies, but it's slightly more minimal than it used to be. It's not as clear as it used to be, and certainly not with the yen either. So I think these recently fashionable safe haven currencies have lost some of their allure.
All right, thank you very much. I think Nick had he wanted to elaborate on that initial question. And the initial question was, in the election, do you think the narrower the margin of victory either way means more chance the election would be contested? So over to you, Nick.
Yeah, absolutely. So yes, that's absolutely correct. Obviously, the narrower the margin of victory, the more likely it is to be contested. And Trump has promised us this. Normally, what happens is for each state, the state is usually conceded before all the votes are counted. So I'm just basically saying that these states might actually go to full count. There's a lot of statistical analysis that comes in to determine where it's past the point of no return for one candidate or the other. I think Trump actually may go against that and actually wait for a full count to come in, and that actually takes quite a long time. We don't get the full count because you got a lot more mail-in votes and so on and so forth that need to be tallied. So there is a big difference this time around because we have such a large proportion of votes coming in by mail, and so we might have to wait a little longer because of that. So the traditional margins may not apply this time around. I hope that answers the question a little bit better.
So on that note, Nick, when you're saying it will take a little longer, are you saying a day, a week, a month? What could you give us a rough estimate?
Yeah, it can take days to get all to, because and obviously this time around, because there's such a large number of mail-in votes, and it is a manual process, and it has to be double checked. There's all kinds of processes in place to certify that part of the vote. It can take time. It can take days. So if you look in past elections, they've got like 95% of the vote will come pretty quickly, and that last 5% actually, because it's manual, takes longer to certify. So that margin is probably a little larger this time around with the mail with the degree of the mail-in vote that we're seeing. So yeah, that's actually one of the reasons we'll see a delay.
All right, thank you very much. So somebody was asking if you can, I know you've talked a little bit about this, but do you see equities rallying at all if Trump was to win? And if so, what sort of time frame? Is it a shorter or a longer term time frame?
Yeah, that's a great question. The Trump presidency has shown us that it's been supportive for equities because obviously lower taxes, decreased regulation. However, most of that is in place now. I'd say on balance, we'd expect equities to continue to perform, but not necessarily outperform, because most of the positives have already been are already out there. It's not like we're going to cut corporate tax rate down to 15% to give an additional boost. So yeah, it might be a grind higher. I certainly don't see a strong move higher. And then again, to the question that how much of this stimulus that they provided for corporate earnings is already baked into the market, yeah, it's potentially could see it sell off. So the verdict's very much out on that. And I think this is just something we'll just have to pay attention to, how investors actually ultimately analyze it and look for developing trends.
Can I add to that, Chris?
Yeah, absolutely.
The issue here, guys, if you actually look at what the fear index, the VIX that we've spoken to you about before, is indicating over the November 3rd election, we've got an elevated VIX now. The VIX is expected, so the fear index, the concern or the volatility around this event is being priced. We expect it to be quite volatile. To ask whether we see a stock market rally in the short term or not, it's almost a binary event. It's a bit of a coin flip, but it's not clear what the triggers are going to be. And I think this is vitally important for anybody who's going to trade these markets through the election, is to realize that the volatility within this is going to be extreme. And so applying something structural like that is not very easy at all. So I would suggest it's almost worth sitting back, riding the news, and then going with something afterwards, rather than try and be clever through the election process and the polls coming out of the exit polls and stuff like that. I think it's just too difficult to do that, and the markets are actually telling you that.
Yeah, that's an excellent point, Mo. Thanks.
All right, thank you very much. So I think that's all of the questions that we've answered there. Sorry for the sound issues tonight. We will make sure that is resolved for next week. Oh, we've got another one. So somebody was asking about the Swiss that you answered, Mo, but do you see the Swiss as a better safe haven? You said the yen, but would you see it as a better safe haven than gold?
Ooh, there's a question. Would I see it as a better safe haven than gold? Do you know what? I think I probably would. I think the problem I have with gold is that gold is also, don't get driven by, there's a massive amount of futures positions out there. I think the market is tending to be slightly long of gold. I think realistically, if we get a shock, if we get a proper, let's say, I don't know, stocks fell 10, 15%, in a short period of time. I think gold would suffer from the problem that all the margin calls out there. We could see gold slip. I think it's difficult to see gold going up when stocks are going down hard. So I think in that environment and that environment alone, the Swiss could be something of a safe haven within that. But having said that, I think the dollar would rally as well. So I think you need to trade your Swiss against something else rather than the dollar. So maybe pick another currency, maybe Swiss Aussie or something like that. Buy Swiss sell Aussie, or buy Swiss sell maybe euro or something. I don't think you want it against the dollar. That's what I'm saying.
Depending on the Brexit issues, would you even consider it about sterling if there was a negative outcome over Brexit potentially?
Well, big ifs there, Chris. I mean, trading sterling right now is, again, you're trying. You've got to take a view on both legs, right? And there's a massive unknown with sterling. I mean, they could come out and say, yeah, we've made some real strides here, we're going to get a deal done. Or they could turn around and say, look, it's still not happening, it doesn't work for us, and we're going to walk. I mean, you are exposed to some serious risk there. And again, volatility is what's going to kill you. And, there's a danger there that if you put sterling against something, particularly over the next day or two, then, I think that's quite high octane stuff. It's going to be high risk. So sterling is an unknown. It's a real unknown at the moment, and there's going to be volatility around that currency over the next few days, in my view.
All right. So thank you, mentors, for all of the content and answering those questions. Again, apologies for the sound. Look, it's going to be a volatile week. Have a very successful trading week, and we'll be back next week to discuss the outcome of the election and much more. So all the best. Have a great week ahead.